So in this video, I wanted to talk about a trade that a member of our Discord is in, JP. They have a call that they purchased, a long-term call. And as you guys know, they've been following the channel or me in the Discord. I really like long-term options as opposed to weekly options. There's more money that can be made in a long-term option because you can hold it longer. And I think you can actually get a lot better results rather than taking the weekly. Plus, there's a lot more fun that you can have with longer term options. And in this video, I'm going to show you how. But first of all, I want to take a moment and have a small rant about Thinkorswim, which is the platform that I use in all of my videos. Today, Monday, August the 17th, they were down for the entire market. I run scans at 10 a.m. every day, and I was not able to run them. Now, I could have taken a bad trade. I could have taken a good trade. I'll never know. But I lost a whole day of trading, and that upsets me. And I still love the platform. It's still the best charting and analytics out there for retail traders, but man, that is just unacceptable. And I really hope that they can get that fixed because I don't know any other platform that I want to go to. That being said, let's take a look at this option using Thinkorswim. My friend bought this JP call on August the 7th. He took the December 2020 100 call and he got it for $7.48. So that was on this bar right here. And I'm a little late doing this video. Last week we were discussing this and it was probably up at the highs here when he was clearly making money on his option, and now we've retraced. I don't think that's a bad thing that I'm getting to this late because now we can see what we could have done, and that's what I wanted to talk about. I'm going to use the think back feature in Thinkorswim to go back and look at the options and set up a back trade, which is back testing of the option. So let's go back to the day that he bought it. Let's find the option. All right, we're going to put in what he paid for it, which was $7.48. So now what we can do is we can go and look at it as time and price go along. So if we look at where we could have evaluated this bar, this daily bar, opened here and closed down here. Think back is only going to show us the closing prices of options. So we actually need to go into the on-demand feature of Thinkorswim to see what we probably could have gotten, let's say at 10 a.m. on that day of August the 12th. Okay, so now we're at August 12th at 10 a.m. Price is around 104. Let's find that option again. So that 100 option, it's got a pretty big spread right there, as most things do this year. But the midpoint is probably going to be, let's call it 11. So if we could sell that for 11 at this point right here, where the chart has caught up, we've got about $352 of profit per option contract at this point. And that's a good point to evaluate it because we basically on that day had reached this high and we're starting to play around there. Of course, I like to look at simple highs and lows, and that would be one of them. One question that people often have when they have a single option contract is, how can I lock in some profits? Well, if you only have one option contract, you can't sell half of that option contract. Some people may take more than one and they can be a little more fluid, but what do you do if you only have one? Well, the simple answer is you can sell an option against it. Now, most of the time when you're talking about selling options against bought options, people think about vertical spreads. These are done in the same expiration. What we're going to look at is diagonal spreads, and these are one of my favorite trades because it really lets you be dynamic with price and time. Also lets you bring down your cost basis, lower your risk on an option, and if you're really right, you can knock it out of the park. So let's look at what we could have done at that point. So I lifted this graphic from the Tastytrade videos on options. They have probably the best series out there that's totally free. I also like their platform, by the way, Tastyworks. But if you really want to dig into options, go through their videos, especially the Mike's whiteboards. They are fantastic at explaining options. But basically, with a diagonal spread, what we're looking to do is we're looking to have a bought option far out in time, and then we're looking to sell options against it. Now, you could sell closer, or you could sell farther away in strike. I like to sell them farther away. You won't get as much premium, but you don't put yourself in a situation where you're going to lose money if it goes against you, especially if you already have profit in the option that you have long. So first we're going to look at a standard risk graph, and this is going to be for a single bought option. So this is on the date of 8/12. At the current price, as we see, because it's trading at about 11, we can get about $344 for it in profit if we sold it. So what I want to do is look at a few options for us to sell premium against it. And we have a few choices. So what I could do is sell the September expiration, which has 37 days to expiration on this date, 8/12, that I'm evaluating. And we could get 305 for it. And that's pretty good. If we add that to our risk graph, we see that it changes a lot. Now, what happens is we get up to that 105, and at that point, our profits begin to decrease. We have effectively capped our profits by selling against it, but we're not going to put ourselves in a negative situation because we've already made some money on the long option to begin with. Alternatively, we could sell the 110, which is going to put our max profit out there at 110. Now, we're going to get less premium for that, only 155, but that lets us have a bigger upside. But this upside only applies up to the September expiration. If price doesn't get up to 105 or 110, we get to keep the full value that we sold it for, effectively buying down our risk on that option that we purchased. And we still get to keep that option because it has a longer dated expiration. Whichever option that you want to sell against it is up to you. The key thing to remember is that we want to sell something that is further out of the money than the one that we have. That way we don't put ourselves into a negative situation, and is a little closer than our long dated option. That way we have a chance that we can capture the full value of that sold option once it expires worthless. And at this point, if we take that our cost basis is $748, depending on what we did, no matter what happens, we're going to offset that initial cost by what we've sold it for. So let's go back to live prices today. We're after market hours, but our original purchase option, we've gone from that $300 profit down to about 31. And again, we still have this 748 risk on the table. If we had sold the 305 against it, we would instead still be up 139 bucks. If we'd sold the 155, we'd be up 92. We still aren't making as much when we were at the high, but we've now offset some of that risk. We've flattened out that curve. And one thing that you can note as you go further and further out past the expiration is that that option will expire completely worthless and we'll get to keep the full value. And now we go back to having a normal option. But at this point, after the September expiry, we could sell another option against it, another closer dated option, maybe one of the weeklies in October. So the possibilities for us to constantly sell against it over the course of this option are limited only by the expiration cycles that we have. Now, you may not always get a very good price to sell against it. You may only get 50 bucks or something like that, depending on what you choose. But you still have to look at that as offsetting your risk, making that initial play cheaper as it goes along. Here is another way to look at it. If we take a look at the December option right now, the theta is 3 cents, whereas the September, let's say the 110, is also 3 cents. So we can hold this long-term option, and by selling against it, because the theta is roughly the same, we have almost negated the time decay. And that's another great advantage of holding a long-term option but selling against it. The downside is just that we have potentially capped our profit, but the upside is if we get it right, we've lowered our risk, we've offset our time decay, and because we can do it multiple times, we have a chance to make a very, very good reward to risk play. If we can buy down the cost of that option to half of what we initially paid for it, but yet still get the full value at the end, that would be fantastic. I can't say where exactly this will go. December is still a long way away. I hope for the best, but I hope this has given folks something to think about and a way to make their options trading a lot more dynamic and get into some of these longer term options for their flexibility. If you have any questions, find me on the Discord or make a comment. We'll see you in the next video.